Welcome to the Office of Justice Programs, Territories Financial Support Center, short video on implementing internal controls. In this video, I will highlight 3 key strategies on how to strengthen internal controls in your agency. Federal regulations require grantees to have appropriate fiscal management systems to provide for internal controls. So, what are internal controls? Internal controls are a set of formal policies and consistent procedures put into place to safeguard a grantee's cash and other assets. Internal controls provide reasonable assurance that an organization's objectives are achieved through effective and efficient operations, reliable financial reporting, and compliance with laws and regulations. There are 2 types of internal controls. Preventative controls are established to keep your organization in compliance. Examples of preventative controls are limits on certain transactions and separation of duties. Detective controls are checks on the backside to make sure there wasn't a human error and your assets are secure. Reconciliation of accounts is a good example of detective controls by providing explanations of the differences between the accounting record's cash balances and the bank balance position per the bank statement. So, how can you establish effective internal controls? Setting up internal controls is an involved process. We know that day-to-day operations can take priority, while the internal control aspect can often take a back seat. But there are some key strategies you can implement to build effective internal controls in your office. These include establishing responsibilities, conducting a system walkthrough, and separating duties. The first and foremost principle of accounting control is establishing responsibilities. Everyone in your agency has some level of responsibility for internal controls. It is critical that you identify the key players in the grants office and explain their role during the entire grant cycle. For instance, the project director, or an identified leader, is responsible for establishing and maintaining the control environment. The financial manager oftentimes prepares the budget and monitors expenditures, while the project director reviews the work of the financial manager and signs off with the final decision. Someone like a principal investigator can be responsible for establishing regulatory compliance, approving authority for fiscal approvals, developing policies that ensure internal controls, and even training employees on appropriate internal control processes. Auditors can also play a role in the system of internal controls by performing evaluations and making recommendations for improved controls. Of course, the size of your staff or office can be a significant factor when defining roles and responsibilities. The important concept here is that the critical functions are covered. For instance, a third party or someone outside your agency can serve as an auditor. Rotating job assignments is another strategy to prevent individuals from engaging in ongoing schemes of fraud or theft. We will talk about the segregation of duties in a few moments and what that might look like in a smaller agency. Another key strategy is conducting a system walkthrough, which is an audit of a transaction by tracing each step within your accounting system. Its primary purpose is to provide a solid understanding of your current accounting system and identify points where concerns regarding internal control design need to be addressed. These include identifying points to prevent errors or fraud. Transactions that you might want to examine in your current process and control designs include purchases of goods and services, cash receipts, submission of expense reports, online banking, and payroll. You may also want to pay special attention to indirect costs, matching funds, and employee time and effort records. These are areas that have been identified as posing enhanced risks for fraud and other misuse scenarios. After mapping out a walkthrough, focus on applying a critical element of internal controls called segregation or separation of duties. Separation of duties is one of the more common control weaknesses. The general premise of separation of duties is that no single person should have multiple roles in an accounting process. For example, imagine an office where one employee is allowed to use a company credit card to make purchases, receive and account for these purchases, review the credit card statement, make payments on the credit card, and balance the organization checkbook. No separation of duties exists here. This agency has allowed one person to perform all relevant functions for purposes of dispersal of funds. This environment increases the risk of mistakes in the process and potentially fraud. So, what would a separation of duties look like in a smaller office? We know that many of you work in offices where individuals wear multiple hats. Setting up effective internal controls in these situations would mean that no individual would perform two consecutive tasks in an accounting procedure. Let's look at an example. Here is a cash receipts procedure, which includes 5 steps. 1, open the mail. 2, endorse the check. 3, make the bank deposit. 4, enter receipts into the cash journal. And 5, reconcile the bank statement. A separation of duties would look like this. Staff A would open the mail and endorse checks. Staff B would make the bank deposit. Staff A would enter cash receipts into the cash journal. Staff C, or a third person, such as a grants manager, would reconcile the bank statements and verify deposit amounts into the cash journal. After setting up separation of duties for a series of accounting procedures, you may want to conduct another system walkthrough to make sure your system of internal controls is effectively designed and properly implemented. This can be part of your ongoing monitoring processes, which assesses the quality of your internal control system's performance over time. In the event that a breakdown in internal controls occurs, you should be prepared to take proper action so your organization can get back on track. Setting up appropriate and timely corrective actions are critical for implementing a successful system of internal controls. This can include establishing procedures for reporting to appropriate staff and developing specific steps to be implemented to remedy the deficiency. Establishing internal controls is a very involved process. This video only briefly touched on a few important concepts and strategies. To learn more about internal controls, we would encourage you to view our short video on the integrated framework developed by the Committee of Sponsoring Organizations of the Treadway Commission. In that video, we highlight the 5 key components of strong internal controls, which are widely accepted within all types of organizations. You can also review our job aid checklist on internal controls. We have inserted the links to these materials in the description below. On behalf of the Territories Financial Support Center, I want to thank you for listening. Please visit our website at www.ojp.gov/TFSC for additional resources, or contact us at ojptfsc@usdoj.gov if we could be of any further assistance. If you would like to stay up to date on our videos, click the subscribe button.
Thank you for watching.